Persistent political and social unrest in Turkey could, according to some experts, deter tourism, destabilise short-term capital inflows, push up inflation and damage economic growth. Joining me down the line to share his insights is Economist Wolf-Fabian Hungerland. Now, with the current account deficit showing signs of renewed widening this year, do you believe that declining capital inflows represent a greater near-term potential risk to Turkey's economy than the possibility that tighter monetary policy could constrain domestic demand?
Yes, definitely I would agree that that declining capital inflows represent the greater near-term potential risk to Turkey's economy than tighter monetary policy. So why is that? I believe that the current account is Turkey's Achilles heel. And the background of this is that there's the big risk of a so-called sudden stop, which is a significant stop or even a reversal of capital flows into a country. And in emerging economies like Turkey, this is extremely relevant because large parts of the economy are funded by foreign capital flows, and typically these are very short-term structured, which means that they are easily reversible. And once capital flows decline, this can easily lead to non-prolongation of loans, etc., and that basically implies that, for example, companies have to lay off workers in order to finance their increasing or refinancing needs, or that they can't even refinance themselves at all, and this basically typically leads to recession, and this is way more dangerous than tighter monetary policy.
Although the CBT's still relatively new monetary policy framework has traction and has helped to rebalance the economy under challenging conditions, it has failed to hit the inflation target of 5%. What do you make of the suggestion that up until recently, supporting growth may have taken priority over price stability?
I disagree. I still believe that price stability is the main concern of the CBT. However, the CBT changed their framework in terms of how they understand price stability. Basically, they say since the introduction of the new framework, which started in 2010 and then in 2012 in various steps, that financial stability is the precondition for price stability. And this is a very Turkish interpretation of price stability because it is so highly exposed to foreign markets and to movements in financial markets in general. So yes, as I already mentioned, inflation has increased drastically due to weaker lira and higher oil prices and also some food inflation. But what is more important than inflation is actually volatility, especially exchange rate volatility. And what the CBRT says is that we want to have stability, especially on the exchange rate front, because this gives us stability also for prices. As I said, one of the main drivers of increasing inflation is actually the weakening lira. So that's basically the interpretation of price stability, namely financial stability matters. And actually, it was successful since the introduction in May 2010 when they introduced their interest rate corridor framework. And within this framework, they actually have some very good working tools as far as we can say now. One of these tools is the interest rate corridor, which I just mentioned, which is basically a setup of 3 interest rates, which the CBT can use to fine-tune, really, to what extent they can perform tightening, and they can actually tailor this much more precisely to the current state of the Turkish economy. However, and this is a big however, we still have to see how this will evolve over the current developments in terms of tapering and in terms of the local protests there. But so far, we trust the CBRT in terms of price stability.
Some analysts believe the sharp drop in net capital inflows, currency depreciation and fall in international reserves remain within the tolerance of Turkey's BBB rating. Do you think, despite this, recent developments serve to highlight Turkey's vulnerability to shocks against the background of domestic political and social unrest and volatility in investor sentiment towards emerging markets in general?
So yes, Turkey has a high exposure to market movements. Investor sentiment matters quite a lot over the channel of the current account and against, again, as I said already, against the threat of a sudden stop. However, this is not new, so I think everybody who is engaging in Turkey should know that Turkey is highly exposed to shocks and sentiment, which can be quite psychological.
Perhaps to combat the imbalance of trade, Turkey is still pursuing accession into the EU. Now, the talks have been going on since 2005, and in the last 7 years, trade between Turkey and the EU has gone down considerably. Do you believe the economic advantages for Turkey to join the EU remain?
Yes, I believe that there are actually economic advantages. But first, one note on combating the imbalance of trade. First of all, I think that EU accession won't really do much to boost Turkish exports to the EU in comparison or relatively to other markets, especially to the Middle East. So in terms of export diversification and export-led growth strategies, EU accession is not so important as export expansion, for example, to Iraq or to Saudi Arabia, Iraq being actually the second most important trading partner after Germany by now. But why do I still believe that there are actually economic advantages for Turkey to join the EU? First of all, being an EU member serves as a seal of approval for economic policy and especially government policy. And as we discussed already, this matters for investor sentiment because they have it much more easier to understand or to judge what economic policy is actually doing and to what guidelines they might have to adhere to if they are in the European Union.
Mr. Hungerland, thank you so much for your perspective today. Viewers, for an overview of the biggest potential market movers and shakers, click back to the website for our Week Ahead programme. But for now, goodbye.